Imagine you invest in a Canadian company and it rewards you with a dividend. Before you can even enjoy that extra cash, the taxman steps in to take a slice. Wait, what? Why are you being taxed on money that feels like a gift? Let's unravel the mystery of dividend taxes in Canada and discover how to keep more of your hard-earned investment income. Hey there, savvy investors, where we break down complex financial topics into bite-sized, digestible pieces. Today, we're diving deep into the world of dividend taxes in Canada. Whether you're a seasoned investor or just starting out, understanding how dividends are taxed can significantly impact your investment strategy and bottom line. What are dividends? Before we delve into taxes, let's clarify what dividends are. When you own shares in a company, you're essentially a part owner. Companies often distribute a portion of their profits to shareholders in the form of dividends. These can be in cash or additional shares and are typically paid out quarterly. It's like a thank you note with a monetary bonus for investing in the company. Types of dividends. Eligible versus non-eligible understanding. The distinction between eligible and non-eligible dividends is crucial as they are taxed differently. Eligible dividends. These are dividends paid by Canadian public corporations or other corporations that have paid tax at the general corporate income tax rate. They benefit from a higher gross-up and a larger dividend tax credit. Non-eligible dividends. These are typically paid by Canadian-controlled private corporations, CCPCs, on income that has been taxed at the small business rate. They have a lower gross-up and a smaller dividend tax credit. The gross-up and dividend tax credit mechanism. To prevent double taxation, once at the corporate level and again at the personal level, Canada employs a gross-up and dividend tax credit system. Gross-up, this increases the actual dividend received to reflect the pre-tax income of the corporation. For eligible dividends, the gross-up is 38%. For non-eligible dividends, it's 15%. Dividend tax credit. After grossing up the dividend, a tax credit is applied to offset the tax payable. The federal dividend tax credit is approximately 15.02% for eligible dividends and 9.03% for non-eligible dividends. Example, if you receive an eligible dividend of $100, it's grossed up to $138. You then calculate tax on $138. But the dividend tax credit reduces the amount of tax you owe. Impact on investment returns taxes can significantly erode your investment returns. For instance, if you're in a higher tax bracket, understanding the difference between eligible and non-eligible dividends can influence your investment choices. Eligible dividends are more tax-efficient due to the higher dividend tax credit. Tax-efficient investment strategies utilize tax-advantaged accounts. Holding dividend-paying stocks in accounts like RRSPs or TFSAs can shield you from dividend taxes. Dividend reinvestment plans, DRIPs. Automatically reinvesting dividends can compound your returns and may defer taxes until you sell the shares. Understand your tax bracket. Knowing your marginal tax rate can help you plan your investments to minimize tax liability. Fun fact about it. Did you know that some investors structure their portfolios to generate eligible dividends intentionally? By focusing on long-term holdings in public Canadian companies, they aim to maximize tax efficiency and keep more of their investment income. Navigating the world of dividend taxes in Canada may seem daunting, but with the right knowledge and strategies, you can optimize your investment income. Remember to differentiate between eligible and non-eligible dividends. Understand the gross-up and dividend tax credit mechanism. Utilize tax-advantaged accounts. Stay informed about current tax laws and rates. By doing so, you'll be well on your way to making the most of your dividends and achieving your financial goals. If you found this video helpful, give it a thumbs up and subscribe to Finance Sensibility for more financial insights. Have questions or topics you'd like us to cover? Drop them in the comments below.